Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, November 17th, 2023. The run of good news for the economy and the stock market continued this week. On Wednesday, we learned that the Consumer Price Index rose less than expected in October, increasing the odds that the Fed will continue to pause on interest rate hikes when it announces its next monetary policy decision in December. Last month, CPI for all urban consumers, or headline CPI, rose 3.2% over the previous 12 months in October. At the same time, core CPI, which excludes volatile food and energy prices, increased 4% over the past year. That was its smallest annual increase in more than 2 years. So here I've got the summary of the report up, and you see these little colored bar charts here. The red one is just all items. Blue is food. And you can see food and all items are almost the same. Energy posted a negative growth rate in October, and the core CPI here in the green box, a little higher than headline CPI, but still less than what was expected. It now appears that the Fed was correct to pause interest rate hikes in June. Since then, inflation has slowed down while employment remains steady and the economy continues to expand. If those trends continue for a few more months, we may not be talking about the threat of inflation much longer. If that happens, then the economic impact of the coronavirus pandemic will have been neutralized with minimal damage to the financial markets. Although the S&P 500 index is lower now than it was 2 years ago, it is only 5% below its all-time high. The unemployment rate in the United States ticked up in October, but was still below 4%. And inflation, as measured by CPI, is also below 4%, as I just showed you. So let's take a look at the S&P 500 over the past 2 years. Here's a chart. You can see over here on the right is where it is right now. So it's not much further below, but it still is slightly negative over the past 2 years. And inflation, as we just showed, is below 4%. Here's the civilian unemployment rate going back 20 years. You see this huge spike at the onset of the coronavirus pandemic and then a huge drop. And yeah, it ticked up over the past couple of months, but you look at the 30-year average, it's way below that, and it's still very close to its all-time low. Now I'm going to show you the yield on the 30-year Treasury note, because even though the yield on the 30-year Treasury note has tripled over the past 3 years to 4.6%, that is still below its average yield over the past 30 years. The fact of the matter is this: interest rates aren't too high, they're just back to normal. That's great news if you're a saver, but not so great if you're a borrower. If Wall Street is looking for something new to worry about now that inflation is under control, it is whether consumers will continue to spend in the future as they have in the past. Roughly 80% of new car purchases are made using some form of credit. Coincidentally, about the same percentage of existing home sales are also made using a mortgage. When borrowing rates are low, as they were a few years ago, consumers tend to spend more. But now that borrowing rates are considerably higher, consumers may cut back on discretionary spending due to the increased cost of debt. It is for that reason that some analysts on Wall Street believe holiday sales this year may come in lower than expected. 2 days ago, PF Growth Portfolio Holding Target released better than expected third quarter results. However, the company was cautious in providing guidance for the current quarter due to its concerns about the strength of the consumer. Now here's a chart for Target year to date, and you can see it's had a very rough year, but look way over here on the right in this huge spike after they released those results. I'm going to push this to just 1 month, and here we are, it's just trending along, and then bam, jumps about 20% in just a matter of a few days. Again, still well below where it was, but Wall Street was not expecting that kind of news. It's not that retailers have reason to believe that consumers will spend less this year, it's that nobody knows how consumers will react to higher borrowing costs. And that's this week's PF Update, and I look forward to talking to you next week. Thank you very much.